from a growth perspective, it really comes back to the fact that we are in an income-driven cycle. Those of you who follow our work regularly are probably sick of me talking about the income-driven cycle over and over again. But I think it's an important framework, mental framework for thinking about, what is the core growth engine of this economy, and what it is at some level very simple, which is that the continued nominal spending growth of households is flowing into nominal earnings growth, whether it's wage growth for households or earnings growth for companies, which is then allowing companies to continue to raise their wages, which is supporting again the continuation of nominal spending growth. That cycle is one which is it is not a spiral, it's self-reinforcing in the sense of one person's income and spending then becomes another person's income and then spending. So it's self-reinforcing, and it is a durable dynamic because the fact that you're spending out of income, if you look over the last 12 months, the savings rate of households is basically flat. And so what you're seeing, as you see on this chart, is that nominal spending is aligning with nominal incomes. And so those things are durable in the sense of there isn't an unacceptable buildup of excesses that occur as a result of an income-driven expansion. The way the way we saw, for instance, back in the '06 to '08 period when there was, a debt boom, or the way we saw amongst corporations in the '98 to 2000 boom, where they were borrowing a lot to invest in new technology. And so this is a very sustainable dynamic, but it's one that is best thought about as sort of consistently being eroded by that tight monetary policy that's remaining in place for an extended period of time. And that's basically what we see. If you think about income, it comes down to basically two sources. Income growth comes down to two sources: employment growth and wage growth. And when you look at that picture, we're basically seeing a sort of persistent grind in terms of both of those elements slowing down over time. Whereas, in 2021, we had very high employment growth coming out of COVID. It moderated, for the 18 months sort of up until January 2023. And really, if you look at the employment numbers over the course of the last year or so, 18 months, they've certainly moderated relative to the strength that we saw before. That's sort of normal in a late cycle environment as we're starting to bump up against our limits. But when you take a look at the combination of both payrolls and the household survey, both of which are like imperfect on their own. Payrolls probably has a little too much birth death support. Household survey has some issues in terms of capturing net migration and the support that exists in terms of measuring the job market there. But when you put the two things together, it's pretty clear that employment growth has moderated to some extent. And remember, this is all in the context of what's being penciled out in terms of expectations is a continuation of the type of strong growth that we saw in 22 and 23 being penciled out to exist for the rest of 24. And then on the earnings side, the income growth side, you've also seen some moderation there. Here, choosing to look at average hourly earnings, although you could look at most measures. What you see is that sort of annualized earnings growth. It was a little stronger a couple of years ago. It's moderated to some extent. And you put those two things together, and what you're seeing is sort of a glacial moderation of overall incomes, which is leading to a glacial moderation of spending. Again, in the context of expectations of that earnings growth and economic growth to be at highs for the cycle. So the real economy is moderating when expectations are basically at highs.